All right, so today we're going to talk about how to use Bitcoin for retirement. So, first of all, congratulations that you recognize that Bitcoin is the fastest horse in the race. It's revolutionary, it's being adopted at a rapid rate, and you can use it to your benefit as the best store of value. So, if you're watching this video, you're one of the few that is able to recognize that. So, congratulations. Um, I think the first thing you have to do is recognize how you're going to store your Bitcoin in order for retirement. The best way for that is self custody, right? Purchasing Bitcoin, if you're purchasing it through an exchange like Gemini or Coinbase, you want to move that Bitcoin offline into cold storage on a hardware wallet where it's safe. That way, you don't have to worry about the exchanges being hacked. You don't have to worry about the exchanges going bankrupt. Um, like they say, not your keys, not your Bitcoin. So that's first thing. Second thing, you have to recognize the three three or four pillars that you can use for retirement, right? Um, and that is number one, your 401k or your 403b. Number two is your IRAs or Roth IRAs. And number three is your HSAs, your health savings account. These can all be used for retirement. If you're using a 401k or a 403b, that's a tax deferred account. If you're using like a Roth IRA, that can allow your money to grow tax free. And then if you have or are eligible for a health savings account, a lot of people don't know that you can save in that account, obviously, but then you can take that money in that account and have it invested, which is pretty cool. So that is also a tax deferred account. And then obviously anything else like the Bitcoin and self custody or your savings is just money that you're setting aside each paycheck, to help you retire. So this video is for anyone who is going to be completely allocating to Bitcoin because they see it's the fastest horse in the race, or even if you're someone who just wants to take a percentage and use it for retirement, that's fine too. So the big thing is if you work for someone, right, and you have a 401k, let's say, you want to take advantage of that match at the very least. So if they're matching, 5%, you should be contributing at least 5%. If it's 7%, you contribute at least 7%. You're probably not going to have access to Bitcoin because usually with a 401k, there's only so many different investment options you can choose from. You're probably going to be most likely in an S&P 500 index fund or a total stock market index fund, something, one of the index funds that are low cost, low expense ratios. But they're going to give you just a typical like S&P 500 return. But it is important to have something like a Roth IRA, right, which you can open up yourself and try to max that out every year. And if you're using a Roth IRA, this is after-tax money that you're putting in. But the benefit of it is that the money growing in that account is all growing tax-free. So when you take it out, it's not tax. You're good to go. And then with an HSA, that is a tax deferred account. So that's money going into the account before taxes are taken out. Right. So using like a Roth IRA and using like an HSA, you have more investment options where you can choose from. And this is where, people might disagree. I've always been a believer that exposure to Bitcoin is better than no exposure at all. Obviously, the best way to buy Bitcoin is through self custody, right? And then storing it offline in cold storage on a hard wallet. It's the best, safest way to do it. But I always was a believer that exposure to Bitcoin is better than no exposure to all. So if your only option is through the Bitcoin ETFs, then buy the ETFs. I am a firm believer in that. I know um, if you buy the ETF, you're trusting the financial institution, right? Uh, it's technically not yours. We can go on and on with all the problems with it, but I if that is your only option, through like a Roth IRA or through an HSA, when you only have so much to choose from, I do think that is the best option. Now you can go another route and you can look at something like I Trust Capital, right? Which is basically a place where you can go through them to buy Bitcoin. Again, yes, you are buying Bitcoin, but technically it's I Trust Capital who owns it, right? Same thing when you're going and buying Bitcoin on Coinbase or Gemini. If you leave it on the exchange, not your keys, not your Bitcoin, but you are buying it. You are buying the Bitcoin and not buying the Bitcoin ETFs. I Trust Capital is something that's set up where you can do that with your retirement accounts. So that is something to look into. I think it's very personal. It depends on your situation. There's a lot of advantages and disadvantages of both sides of it. So something to look into. But then now that we have the pillars set up of what you can use, you need to establish a number, a retirement number, because retirement isn't an age, it's a number. It's whatever your portfolio needs to be in order to retire. So, and it's different for everybody. It just depends on what you want to do. Maybe you need $1 million, right? And that $1 million, you know what? It's gonna cover your bills and that's it. You're happy. Yeah, you might not be taking these lavish vacations and going out to restaurants all the time, but you know what? It's better than not working, or it's better than working, right? Um, Maybe you're someone who wants to do everything in retirement. You want to take the lavish vacations. You don't want to worry about money at all. So you're going to need a lot more. Maybe you need 2.5 million. Maybe you need 5 million. So I think the first thing you need to do is to sit down and think, what does my number need to be? And again, this number is a combination of everything. This is your 401ks. This is your IRAs. This is your HSA. This is money in Bitcoin and your savings. So this is the number that is total for your portfolio. And then once you have that number, I like to go off of the Trinity study. Anyone who doesn't know what the Trinity study is, it was a study that was taken place a while ago. But it basically followed people in retirement to see what their withdrawal rates were, basically to find out how much were you able to withdraw and what were you able to be invested in, so that you wouldn't run out of money in retirement, right? So basically, they had multiple groups. They had like the 5 different groups invested in. Like one group was invested 100% in stocks, one was 100% in bonds, one was 50-50. So you get the idea. They layered all of them, and then they had the groups or the people withdraw at different rates. So some people were withdrawing at 1% of their portfolio every year. Some people were withdrawing at like 10 or 12% a year. And basically they followed them, I think it was over like a 30-year period, to see basically which of them, which of them had money to last, right? Theoretically, what scenario would your money last forever? And there's basically 2 things that they found. One was that the people invested 100% in stocks, or 75 stocks, 25 bonds. were able to theoretically have money forever in retirement. That was the first thing. And the main reason for that was if you were too heavy in bonds, your money just wasn't growing at the rate that it should be. Yeah, you're technically playing it safe, but you're not getting a very good return. So as you're withdrawing, your portfolio keeps decreasing. Whereas your portfolio really should be increasing, even if you're withdrawing, because it's still invested, right? Um, so we can kind of apply that with Bitcoin because it's a heavy return asset, right? In the past 4 years, it's done over 40%. So, so that's one thing to look at. The second thing they found with the study is that 4% was the number. 4% was the percent that you can withdraw from your portfolio every year, and theoretically, you will not run out of money. So you could have withdrew at 4%, 3%, 2%, or 1%. Anything lower than 4%, you could theoretically withdraw every year and you won't run out of money. Now, anybody who's going over that did run the risk of running out in retirement. So that's just something to consider when you're trying to figure out what your retirement number is. So let's say you only need 40 grand a year to retire. It covers your bills and that's it. You're good. Then 1 million would be your retirement number, right? Because that's 4%. And every year you'd be able to pull out 4% from your portfolio. And theoretically, you should be able to live off that for the rest of your life. If you want to live a more comfortable retirement where you do want to take a vacation, go out to restaurants, things like that, maybe it's 2.5 million, right? So then 4% of that would be 100,000, right? So now you're living off of 100,000 a year. And that number will change because as your portfolio is still invested and it keeps going up, you're still taking 4%. So you don't have to worry about inflation because it's covered, right? Because your portfolio is still invested. That 2.5 million is invested. It's still going up and you're withdrawing 4% every year. 4%, 4%. So that 100,000, the next year it's probably going to be higher and the next year it's going to be higher. So it'll cover the inflation cost that you're going to see. So it's just something to consider. Now, with Bitcoin, it is a little harder to figure out exactly what the returns are going to be, right? Because we know, like with the S&P 500, you can probably expect anywhere from 10 to 12%. Some people say 8%, somewhere around there, because we have a longer time span of what the S&P 500 has done. But with Bitcoin, at least we know, like for the past 4 years, it's done at least a 40%. Michael Saylor has noted that eventually, it's going to tick down to 35%, then 30. Eventually, it's going to get to a point where it's returning at 8% higher than the S&P 500. So if you want to play it safe, you can just assume it might be 20% as a return and use that calculation. There's calculators online that you can plug all these numbers in, mess with it, and figure it out. But yeah, that's definitely what I would consider is using that 4% rule. Try to utilize as many retirement accounts as you can to help you out. So that's your 401k, your IRA, your HSA, a brokerage account, and then, anything you're putting in to self-custody for Bitcoin. Always use self-custody. Don't leave your Bitcoin online. Don't trust it with these financial institutions, right? You always want to try to self-custody if you can. But at the same time, I do believe that exposure to Bitcoin is better than no exposure at all, even if you have to use the ETFs. So that's my take on it, and I'll continue to keep you guys updated. Thanks.